Why foreign investors are exiting India. Foreign institutional investors are offloading their holdings in India at a scale not seen in years. Regarded as one of the key drivers of the locally listed equities, relentless selling by these investors has raised concerns about the health of the local market and the broader economy. After selling equity worth 1.14 lakh rupees crore through exchanges in October, FIIs have sold another 42,000 crore rupees of equity so far in November. Before October, the peak selling by FIIs was seen in March 2020 when the COVID-19 pandemic spooked the global equity market. According to market experts, many factors are driving this trend. They, however, are confident that FIIs will return to India given the nation's long-term growth story remains intact. Global factors at play. There has been a shift of funds from India to China. The combination of perceived safety and growth opportunities in the US market, along with rising US bond yields and a strengthening dollar index, has influenced investor decisions. A recent ICICI Direct report also states that one of the main reasons for the FII exit is the potential for higher returns from the Chinese market. FIIs seem to prefer moving to China as it is trading at less than half of India's valuations. In other words, these foreign investors find investing in Chinese equity markets is less expensive than pumping money into Indian bourses. In September, the world's second-largest economy introduced a series of stimulus measures to boost its economy. The uncertainty created around the US presidential elections and the outcome also played a major role in the FII exodus. We believe Trump's plans for lower corporate taxes, higher import tariffs, and deportation of illegal immigrants will result in growth of the US economy, higher inflation, higher interest rates, and a stronger US dollar. This might tempt FIIs to take at least some portion of their money to the US. Higher interest rates in developed markets make them more attractive for investments, reducing the appeal of riskier emerging markets like India. US Treasury yields, in particular, have surged, drawing capital away from equities worldwide. Expensive valuation, poor earnings. Market experts also weighed down on the premium valuation of the Indian market, as it leaves little room for investors to make money. The Indian market median price-to-earnings (PE) ratio, starting in 2007, is 21.9. Before the recent fall, the Nifty 50 PE was over 24, which makes the Indian market overvalued compared to other emerging economies. As global markets offer more attractive valuations, FIIs are shifting their focus to other markets. Further, a weaker-than-expected Q2 FY25 earnings season raised concerns about the growth prospects of Indian companies. India companies saw net profit growth of 3.6% during the September quarter, which was the slowest growth in 17 quarters, driven by sluggish revenue growth and rising interest and depreciation costs. The other major factors are the ongoing geopolitical tensions in West Asia and the war between Russia and Ukraine. A pickup in retail inflation in September also hampered sentiments as it can reduce consumer spending and impact corporate profits. Why FIIs are important? FIIs play an important role in emerging markets such as India. They bring in substantial capital flows, driving liquidity, sentiment, and price discovery. When FIIs buy heavily, Indian markets typically rally. Conversely, heavy selling can drag down indices and trigger bearish sentiment. Even though the share of foreign investors in NSE-listed companies dropped to 15.98% in October, the lowest in 12 years, they still have a significant influence over the market. The sustained FII selling played a major role in pushing down India's benchmark indices, the Sensex and Nifty 50, by 11 to 12% in less than 2 months, wiping out gains made earlier in the year. Mid-cap and small-cap stocks, often more vulnerable to FII flows, have faced steeper declines. Additionally, retail investors, who have been actively participating in the market over the past few years, have been hit hard by the FII selling. Many are grappling with portfolio losses, and sentiment has taken a hit. The sharp corrections have also impacted mutual funds, especially those heavily exposed to FII-favored stocks. Will FIIs come back? The street is broadly divided on whether FIIs will start buying in the Indian market in the short term. However, they believe they will return over the medium to long term. US Federal Reserve is likely to pause its rate cuts, and with expectations of a sharp rebound in Indian corporate earnings growth for FY26, along with more attractive valuations for Indian stocks, FIIs are expected to begin reallocating incremental investments into Indian equities from early CY25. This is driven by the expectation that India's GDP and corporate earnings growth will be among the highest in emerging markets. This is the time to re-evaluate investment opportunities in India as valuations correct and analyst estimates become more realistic, as India is still the best long-term structural growth story. Last week, global brokerage firm CLSA reversed its early tactical shift from Indian equities to Chinese stocks and decided to raise India allocation while cutting exposure to China. In its report titled Pouncing Tiger, Prevaricating Dragon, CLSA cited challenges facing Chinese markets in the aftermath of Trump's victory in the US elections as the reason for the move. However, not everyone buys this theory. Advising caution, market veteran Shankar Sharma warns CLSA that raising allocation to India while cutting exposure to China is a trap for domestic retail investors and domestic institutions. In our view is that FIIs will return to India given the nation's long-term growth story remains intact. Thanks for watching. Don't forget to like and subscribe.